Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, Lance Peterson. So today I have Kevin Kim with Geraci Law. How you doing, Kevin?
I'm doing well. Thank you for having me on the show, Lance.
Yeah, super excited to have you on. A bit of backstory. So I've known Kevin for years now. They're one of our strategic partners, Verivest. We have many mutual clients. A lot of our clients are, mortgage pool fund managers, or running debt funds, or private lenders. Geraci is really the leading law firm in the country, based down in Southern California and Orange County. But they've got clients all over the country, which Kevin will tell you about in here in a few minutes. But they do a lot of securities work, a lot of the real estate related stuff, loan docs. They're huge advocates for the private lending industry, lobbying and doing everything they can for their private lender clients, and put on conferences and just do a lot of great things to help carry this industry forward, which is great. And their founder, is played a huge role in that. So, Kevin, why don't you share with us, sort of from your perspective, how you kind of got into the business and landed at Geraci, and
I mean, so Geraci was kind of an accident, right? So I was let's go back before law school, right? So I was a commercial real estate loan officer at a regional bank after college, and it's now merged into what's called Bank of Hope. It was a small bank back after I got out of college, and learning how money works was an interesting thing for a legal studies major out of Berkeley, right? Who had no idea. Didn't know how credit cards worked, didn't know about anything. I learned how money worked very quickly. Got to learn to love real estate and finance, and I think it's in my blood. My father was a banker. His father was a banker. And so, that was great. But then, I looked at, I guess what I call upper mobility in the banking industry, and it seemed like everyone was a VP. And I was like, well, I was kind of having a little bit of a personal crisis. Like, I'm not really, interested in being a VP for the rest of my life. And, talked to my dad about it, talked to my mom about it. They're like, yeah, we would really like it if you got a professional degree. I'm like, well, what are you thinking? I was thinking about going to work for Wall Street. And they're like, no, we think you should get a professional degree. I'm like, okay, well, I'm not very good at math. So, CPA's out. And, I like talking to clients, and I enjoy I enjoy finance and those kind of things. So they said, I recommended law school, and I thought about it a little bit, and it made sense. And then I had studied kind of similar things in college. I was like, all right, well, let's do it. So I went to college. I went to law school at Loyola, and spent the entire 3 years there just like concentrating on corporate and real estate and commercial and finance and securities work, everything I could get my hands on from a transactional standpoint. Got out of law school, Great Recession, right? 2009 happens, and I was actually slated to work in Washington D.C. And of course, freezing higher freezes across the country didn't work out. And I think in a small job, a corporate job in Koreatown in Los Angeles, and that was great. And then with law firms, the recession kind of extended until 2011-12. So I got laid off and opened up my own law firm, and was doing contract work. And that's how I ended up at Geraci. Literally, I was looking for contract work, and they were looking for an attorney who could essentially do corporate work and some securities work. And Geraci back then was a lot smaller than it is today. 5 attorneys, a small office in near the airport, John Wayne Airport. Yeah. And joined in 2014 as a contract attorney, and I loved it. I mean, it was exactly everything I loved about being at the bank, and everything I loved about I love studying at law school. And it was a small firm, so it was very entrepreneurial. Like, it wasn't this big stuffy law firm.
Totally.
That and so you can kind of make your own way. And I was really lucky enough to join at a good time, and Anthony and Nima and, a couple of partner that has since retired, really, started taking the business really seriously and started to take off along with the industry itself. And, and lo and behold, a couple years later, I'm taking over the department, and then making partner and growing the securities division, and being part of this great journey has been awesome because, we've been, really attached at the hip to this private lending industry. And we've seen it grow from what I would consider kind of mom and pop type of business model, to an industry that is, loved by Wall Street and loved by financial institutions and high net worth investors and family offices. Everyone loves the industry from an investment standpoint. And not only that, but it's finance related. It's mortgages, it's credit, and that's just the stuff that I love. And it was really, really great because, I've never been part of anything like that before, right? And it was, not just the lawyer in me, but the business person in me, and the person that just craves that kind of entrepreneurial experience. It was wonderful. And we've grown the firm now. I think we're now 30 40 now. I think actually 40 plus now. And our headquarters are in Irvine still, but we've got people and staff all over the country, and clients all over the country. We used to be a California firm, now we're a national firm. And it's just been really great, growing the business alongside my partners, and working and building relationships with companies like yours, Lance, and sharing values and interests and serving our clients and their growth. So it's been wonderful from that standpoint. And since then, since my starting with the firm, we probably put together over 1,000 private placements, both for real estate and for mortgage guys, and couldn't be prouder.
Yeah. No, it really has been. It's interesting to see, like you said, you got in, that 2014 timeframe. I mean, I'll never forget. I mean, back then it's like investors, you talk to a high net worth investor about this stuff. I mean, you talk to an investment advisor, you talk to anybody, they thought that, they're like, it's too good to be true.
Right.
I mean, like this, I don't get it. It doesn't make any sense. Like, I don't see how you could ever do that.
Yeah.
I mean, it was weird because it was almost like they viewed it as like borderline criminal that you're charging, 14% interest,
right,
points, or 12 and 2 or 10 and 2 or whatever, and obviously we've seen some rate compression, on the, interest rates and the loans and things over the years, but it really wasn't that long ago when people they flat out did not understand
right,
how they could, make an equity investment into one of these debt funds or mortgage pool funds and get a 10% return. They just thought someone must be doing something illegal.
right.
So now, as we sit here at this very moment, like you said, Wall Street figured it out. They figured out what's going on, and it's literally become institutionalized.
Yep.
Over the last 7 years, which isn't that long of a time frame. So maybe share a bit with us, like how that's look, because I think that what I try to stress, and I just think that you got to keep repeating ourselves here, and I think it's good to get your perspective because you've been deeper in it, I think, than even a lot of some of the end user, the private lenders. I don't think fully appreciate what's been going on behind the scenes, but what was it like? When was it that, and what was happening and what allowed it? Because I know for you guys, you do a lot of the loan docs, right? So there's a difference. And when we talk about mom and pop, I think mom and pop is back in the day, you just saw some really weird stuff in loan agreements. Yeah. I mean, like it was nuts.
Oh yeah. I mean, to this day, we have new lenders from all across the country and people who have been doing it for some time too. And they've just been doing it privately as an investor, and you'd be surprised, right? And that's been the nice benefit of I guess what we call institutionalization, is that the demand for quality has come up. But yeah, I mean, you got to look back to, I mean, before I started, and I had been exposed to what is called quote unquote hard money at the bank, and we were typically taking out the hard money lender, and it was we all thought it was loan sharking, right? And there's no way this could be legal, right? And I was a banker. And then when I went to work for Geraci, I learned that it's a legitimate industry, and I understood it, and I was shocked. Right, I was like, "Wow, they're getting." At the time, I think the going rate in California was 12 and 2, right? And so, And I understood the idea of a bridge loan. I understood the idea of the higher rate and the higher risk and all that kind of stuff. But what I didn't appreciate was kind of how the capital flowed, right? And what was until I would say, okay, so let's just kind of use 2008 as kind of the great reset, right? So from 08 until I would say 12, 13, even up till 14, 15, the vast majority of this industry was funded in two ways. It was one, a private investor who wanted to be the lender and funded the deal entirely with his own money. And him or a group of investors would fund an actual loan. We call it co-lender, right? And they would co-lend on the loan together. It still happens to this day, but it's not very common. And then you had funds, right? And these funds would essentially be the lender, pool the investor capital, and hold the loans on its balance sheet. That's still a model today, and those are the clients that we share. But but this was all privately funded, right? This is all funded through individual high net worth investors, and there weren't many institutions paying attention. And I think the reason why, really, to put it simply, was everyone was reeling from 08. If it looked like a mortgage, they wouldn't want to touch it.
Yeah, that's a good point.
And the idea, and also they didn't want the press, right? It was kind of a 4-letter word to be involved in the mortgage space. But in reality, what's kind of funny was starting in 12, you started to see a lot of financial institutions start, the iBuyer trend became a thing, right? Because you had all those houses available at the courthouse steps. And so you started seeing a lot of institutional attention head toward the housing market.
Yes.
And buying a lot of the distressed houses. Natural evolution. This is true for any investor, right? And I have so many clients who are lenders who are former flippers, right? And so the same logic runs true, I believe, for Wall Street. They were initially started buying houses and they realized, wait a minute, there's an opportunity here on the debt side. And lo and behold, I would say early 15 and then really got hot and heavy in 16 was these, larger institutionalized proxies. So they weren't the actual investment banks that we saw in, pre-08. It wasn't Merrill, it wasn't Morgan, it wasn't Lehman, it wasn't these kind of companies. They were behind the scenes and they were tapping people to handle, an allocation to go out there and buy up these loans.
Okay.
Right? That was the move. Like, we're going to buy up these loans. We want to buy these loans and we're going to buy them at par because at 10%, they're 12%, right? They're 65% LTV, and we're going to buy them at par. And that's going to be the business model. And some of them said, we're going to take that and try to securitize, right? That was the start. And I think what I've realized in meeting some of the folks who do this, the story actually runs back further to like 14-ish, but it was very much kind of coming out of the primordial ooze for them because it was still kind of a challenge to do it. From 16 onward, I mean, I would say until 20, it was, and it still is a very, very frothy market from a origination side, because you had basically unlimited Wall Street capital flooding into the market saying, we will buy your loans, right? And here's the box, and we will buy your loans. And until 2020, it was probably close to par, right? 10% loan, we'll buy 10%, points, maybe a point spread. That's about it, right? That changed in 20 with COVID. When COVID hit, March hit, in the liquidity and credit crises, Wall Street, they're very sensitive to that, and they all have long memories thanks to 08, and they had to pull out because of liquidity. And that's when a lot of the old school methods that I talked about earlier came back. And we had a record year during 2020. More people said, okay, I need a balance sheet, right? Yeah. I need to have my own captive capital that I control and I manage. And I can't just be reliant on one single iron in the fire, aka Wall Street, right? And so, and that became kind of a really, I mean, it was a boon for my business, but it became kind of the blueprint in the space now. And I think right now, if you look at a lot of the larger players, they're kind of following suit. They have a fund, balance sheet capital. They raise money for that, high net worth investors. It's a Reg B typically, sometimes a Reg A, and then they also have some solution with Wall Street where they're selling loans or they're getting a credit line or something like that, and they're having both irons in the fire just in case, right? Just in case. So
yeah, no, and that's the last guest we had on the last episode is a client of yours, right? And that was what happened to them, right? They were they reliant on that Wall Street capital and that secondary market to sell the loans, and it went away, and they realized they needed discretionary capital or balance sheet. And so I think the important thing for most of our listeners, right, who are generally passive investors looking at investment opportunities, is just, I think, and you hear me say it if you listen to the show at all, right, but it bears repeating, is that it's when Wall Street decides to get into something and they like it, they go all in until they suck the air out of the room. I mean, look no further than what used to be referred to as peer-to-peer lending with like and Prosper and those guys. They don't call it peer-to-peer lending anymore because most of that paper is all bought by institutional investors. Now, downstream somewhere, there's some retired, some fireman or some school teacher or, government employee that's probably on the other end of it through their pension that has exposure to these things. But, it's just important to understand that, to the degree that you qualify as a high net worth, as an accredited investor, that, some of these things, it's sort of like you got to take advantage of them while they're there, because you never know. And, we saw this even with, no one ever thought that the institutional investors would do what they did with the single family market, who, for years and years and years, right? they just stayed away from it because there are way too many moving parts. And instead they just, because, well, one, they got burned by the mortgages on those deals, turned around and, and realized, like, this is how we recoup, as we go and buy all the stuff back and rent it out, and we're just going to power through it. And it's been a mess. And I think it still isn't great. It's not a great experience.
It's still crazy. It's so frothy on that side. And I kind of blame that for the high inflated values. I mean, I saw an article the other day, 1 in 7 residential, so SFR, right? 1 in 7 SFR in the United States is owned by a financial institution.
It's crazy, because it used to be like 1 out of 60, or it was like, it was non-existent. So I think you look at these, once again, and that's a lot more moving parts than these debt instruments like a trust deed or mortgage or whatever. They're far more portable. They're far easier to sort of trade. Clearly they figured this out. So it's good to see, right, that I think a lot of the private lenders, people who originate these loans, our clients and Kevin, your clients, right, is that they realize that, hey, it is, you can't, like, as you said, you can't just have one iron in the fire. You really need multiple sources, ways to kind of fund, deal flow. There's always going to be that's the beauty of real estate, right? Is it's very cyclical. Neighborhoods, gentrify and they come back, and, like, that's just the cycle of life. Right. And so there's always opportunity. And, and what we really seen coming out of the global financial crisis is the banks' unwillingness to really be lenders like they have been historically. Like lending is really, you being a former banker know this as much as anyone. They just, lending isn't really the main game anymore for most banks. But it used to be, that sort of was synonymous. Banks lent money.
It's risk management now. That's what banks are all about.
And fees and
management.
It's just different. So good news for the private sector, non-banking institutions, is that it opened up this void and the ability for, and ultimately, I think, they deliver a better service. Lenders are more service oriented and more strategic and those sorts of things. So, I think it's gotten, a lot better. I think maybe share with us too, just the challenges that the industry's faced. Cause I know that you guys have been very much in the forefront. And I think there's some things that have gone on that you guys have really behind the scenes been working on that I'm not sure that people are completely appreciative. And there's a handful of them. Maybe just share one of them that sort of,
I mean,
are proud of.
Big picture. I mean, there's a lot of things that we work on kind of to make sure we elevate the industry, right? And there's cultural issues, there's best practices issues, and then there's government issues, right? And so, the two things I like to highlight. The first thing is best practice issues, right? We saw a lot of fraud entering the market very, very early on when the institutions jumped in, because they had a defined box, and if you could make it look like it, you're fitting that box, you could really just continue to sell to them, and you really had, it was kind of a wild west kind of scenario. We saw a lot of that kind of correct itself, thanks to best practices, pushed by those buyers and those secondary guys, but also by trade associations that are actively involved in the space. That's one really important thing, because we saw a lot of bad actors very early on, and it's kind of gone away, and some better practices have been inserted. But on the other side of things is like kind of government threats, I guess you can call it. And this also rings across the spectrum into real estate. There's kind of two big areas that we see as threats to private lenders. And the first thing is licensing, right? And the reason why is because, our lenders are making loans secured by residential real estate, but the end borrower is a investor, right? It's a business purpose loan secured by residential real estate. So really, it's a commercial transaction. Unfortunately, the government still doesn't quite understand that this exists, right? And so early this morning, I was on the virtual day on the Hill with the American Association of Private Lenders, and it was still fascinating, like how many people still don't know this industry exists. And frankly, it's a very niche industry still, while it's still all over HGTV and all that kind of stuff, right? It's kind of funny, right? But in that regard, right, we want to make sure that consumer purpose licensing rules and consumer regulations don't reach us, and we fought hard to prevent that. And my partner Nima, God bless him, he, when Florida tried to institute licensing to all residential lending, not just consumer residential lending, he was flying to Florida like once a week, twice a week to advocate on behalf of the association we're a part of in front of the local assembly. And we were successful in preventing that bill from actually passing. Recently, we've actually been advocating against a federal bill. Many of us have probably heard of the $3.5 trillion budget bill, or the Build Back Better Act, as it's called. And I won't get into the politics of it, but there are two sections in there that are very relevant to your listeners. Why? It's because they essentially say if you're an IRA investor, you can't invest in private securities that are offered under Reg D. So that's why if you go on our website, we have a big campaign going, #SaveRegD, right? Because this would kill not only real estate syndications and real estate funds and debt funds that are reliant on self-directed IRA money to be a big chunk of their capital sources. But not only that, but if you think about it, the way the proposed bill is written, in 2023, those investments would have to divest and then place that capital into an eligible investment or just liquidate. What does that mean? Well, if you can't invest in a privately offered security, what can you invest in? Well, it sounds like Wall Street, right? Exactly. And so we're strongly advocating against this component. And the reason why we're so adamant is because it doesn't produce any tax revenue. This is a tax bill, right? So this is not a tax. This doesn't produce any tax revenue. All it does is say you can't invest in certain things if you happen to be in an IRA. And I get it. I mean, if you are a IRA, if you're a billionaire using a backdoor IRA with hiding tens of billions of dollars, I get it, right? That's the rationale behind it. But don't legislate so that this impacts, millions of investors who are, who've saved maybe $1 million, maybe less than $1 million, and want to have a little bit of capital in in real estate or a debt fund. Something that's non-correlated. We're fighting this very hard. So I encourage all your listeners to go on our website, GeraciLawFirm.com. There's a link there. You can download the form letter to send to your congresspeople on behalf of the investor. If you are an IRA investor, also speak to your custodian, because they are also doing a strong advocacy program to fight this legislation. So it's a very big thing we're working on. It's probably one of the biggest threats we've seen so far. So. Yeah,
no, and I agree, and it's a huge threat. Whether you have an IRA, right now or you don't. I think that's part of it is that you should. In this threat, just to be very specific, right, is that they're basically saying any private placement that requires you to meet some standard of accredited
net worth or financial education, which is essentially Reg D, the definition of an accredited investor, right?
That's right. So it's
no other.
So if that, then you can't use your IRA, can't use your self-directed IRA to invest in it, right? And so that's a huge problem. For people, and especially given the fact that most of the number of investments available in the public markets has shrunk significantly over the years. So the number of options you have, and then you're directly correlated to the stock market,
right?
It just takes away. And once again, it's where it's coming from, right? Is clearly Wall Street has realized that there's a lot of money sitting in these IRA accounts. that, you know, they'd much rather have placed into their retail type investments. You know, it's just so obvious. I mean, Blackstone has opened a fund that's targeted at retail, you know, more retail or high net worth investors. It's sort of like an untapped final frontier for them, for many of the largest asset managers. And I mean, and these are the firms that, hey, I mean, I'm a capitalist, I get it, you know, go for it. But I mean, they're all taking it to the extreme. They're on this arms race to be the largest asset managers in the world, which is basically code for they don't really care about anything but, you know, some vanity metric, you know, of just accumulating as many assets as they can.
Right.
And, you know, and that's how they kind of look at this, like they're playing some, you know, global game of Monopoly or something. It's just, these are the things that if, I mean, one, this is why we do this show, right? It's why, like you said, like you guys and part of, you know, AAPL and advocating on behalf of lenders. I mean, that's a part of just being a citizen of obviously this country, but a global citizen, is that we have to sort of educate and inform ourselves, and we can't be ignorant.
Yep.
And on the show here, that's what I'm saying. Like, I don't like to see when investors invest for bad reasons. Like, if they don't have a process and they're just throwing money at things because their buddy did, or the pictures are pretty. I mean, that's just not a, you know, not a great idea.
Right.
And you see what's happened is that we've moved from, you know, being sort of a pension driven, you know, hey, I just go to work for 50 years and, you know, and then I get a pension, to, you know, the 70s, they're like, you're on your own, and the 401ks and the IRAs. And then people just sort of still continue to abdicate that decision making to some financial advisor, investment advisor, who basically same thing more often than not.
Yeah. S&P 500 life insurance, right? What else is there out there? You know, and that's what drives me nuts about this, is that the self-directed IRA community and the industry is big, but it pales in comparison to the standard IRA, you know, wealth advisor type programs out there that exist, right? But these people should have the choice. They should have the freedom to choose what investments they make. And to your point, you know, I told the senator that I met, the staffers that I met today, I told them, like, the SEC put out a report, right, last year when they were harmonizing the rules, and they put out it was like $13 trillion was raised between 2009 and 2019 using Reg D. And, you know, a lot of that was these small, you know, private funds that invest in real estate or startups or venture. Yeah. And if you want to invest in this, you should be able to. What's stopping you, right? And then I think that this all goes back to that ProPublica article about Peter Thiel. And I'm just like,
I know,
if you want to go after the billionaire who used the backdoor rule, tailor it narrowly, because if you do this, you're going to kneecap an entire. And I have clients who are reliant, who have 99% IRA money in their funds, right? They've built their business on IRA money, and this would be, I mean, just terrible for their business. And for real estate syndicators and closed-end funds, it's a huge resource. And so it's just
well, not to mention, like right now, I mean, just okay, if it passes as it stands, okay, there is no secondary market for this stuff. So what's going to end up happening is that, like, all of those, like, how are you going to get out of these? You're going to take a huge haircut to get out of the position, right? So if you got 100 grand invested in some closed-ended vehicle, or, you know, some fund where you have no redemption, right? Or there's no exit strategy. The reason why you invest your retirement money in the deal to begin with is because it had a longer time frame, right? Like, it's a good investment. Now, hey, I get it. You can make the argument all day long as maybe it's too risky for some, you know, but that's the whole point. If you're a credit investor, you listen to our show, you know, you're smarter than the average bear. You're a little more sophisticated. You know what you're getting into. Right. But you put the money in there because you didn't want the money back, because it's in your retirement account.
You want to be earning.
They're going to pass a law and say you got to get out of that position when it's inherently illiquid, and then you're going to basically take a haircut.
Their justification is you have 2 years to do it. I mean, that's not long enough. To do it.
And if you're going to get out of it, someone's going to be like, yeah, I'll take you out in cash. I'll buy 50 cents, 60 cents in the dollar. So now you've lost that money, not to mention that, where are you going to go invest it? Or, you know, like, you're going
to be forced to invest either in annuities or in public securities. Right. And then that's at its core where what I find, I mean, I don't want to get too political on this, but like, this is what I find to be the most offensive. Right. So when I first started practicing securities, it was all about, like, it's so restrictive. And then all of a sudden the jobs that came out, 506C came out, Reg A came out, and it became a thing. We want to make it easier for private companies to raise money. We want to make it easier. That was the Obama administration. And all of a sudden now they're saying, wait a minute. If you have an IRA, you can't do this investing. What? These people worked hard to save some money up, and they put it into a vehicle that they can invest in alternatives, and they should be able to. And your government said that they should be able to as well. Now you're saying we can't. And I find it to be just it's very I find it to be offensive personally, but I also think it takes away the freedom of choice, right? And there's not a lot that self-directed IRAs can invest in. They're regulated. They're heavily regulated. This is one thing they can, right? And they should be able to. And that's
I agree. And it was interesting too, because, a week after that sort of surfaced, one of the SEC sort of committees that was gathered and had, some guys from, I don't know, the big four, and, and so they basically they wrote this, it's 15-page paper about how to expand access to the private markets, and so it was sort of, and then the articles that came out in the Wall Street Journal, whatever, sort of positioned it as though SEC committee recommends greater access to private investments for investors, right? So of course I'm going, oh, this is great news on the heels of this. Like, we're going to eliminate your ability to invest, in a private placement Reg D offering with your IRA. Well, of course, I then go read every word in this article, and I get to the bottom. I realize really quickly the agenda is basically them saying, you know what we think we should do? We should take these gigantic asset managers and allow them to create these investment vehicles where you're an investor who's non-sophisticated, doesn't know what they're doing. You put your money into their deal, and then they're going to get to pick and choose who the downstream managers are that, meet
right.
their criteria. And I'm going, yeah, I see what's going on here. It's the same group of people that are just going right pocket, left pocket, into their, it's just the big rich kid.
In that sense, it's kind of similar to what I'm saying. It's kind of a try to consolidate power almost, right?
That's what it is.
At the financial institutional level.
Yeah.
Takes the power out of the actual guys on the street that know what they're doing, right? And can actually generate, engineer, and manufacture returns that are very healthy and are fee light, and there's a little bit of that, trust there, as opposed to some giant financial institution who doesn't care if you lose your shirt, right? So
they just want big numbers in their fee, and then they're going to take their 75 basis points, and it's sort of like, yeah, I mean, it's always interesting, but it's from the investor standpoint. You're in these positions, you qualify, and
I encourage anyone who's an investor. If you're an investor, this should be getting you, up and at them, and so make sure you find that letter from our website and send it to your Congress people, because they don't know about this.
No,
like they don't know it exists. They're concentrating on the tax component. Yeah. Right. They're concentrating on the increased tax rate, and that's fine and dandy. I have my personal views on that, but you know what? Elections have consequences.
Yeah.
This is just like arbitrary. So, and this is a sleeper section. It's going to kind of like slide in, right? They're all going to be concentrating on those sections. This is going to it may get removed or not, but it's going to slide around, and no one's going to pay attention to it.
That's right.
This is why it's so important that we get involved in all the investors. This is actually an investor campaign. We want our investors to get involved. So I think, Lance, definitely get your people involved, and all of your listeners. I think you should get fired up about this, because it's definitely a big threat. But for the private lending industry and the real estate industry as a whole, we've never seen a threat this dramatic. And we're really pumped to, advocate on behalf of the industry, both sides, not only the, lending industry, but also the real estate industry, and really go at it from a aggressive position. And thankfully, AAPL and Think Realty and our law firm and other groups are really getting active in doing so. So.
Yeah, no, it's super important. Yeah, we've been putting it out in our newsletters, and yeah, I mean, it's, if you don't let your voice be heard, you don't do anything about it, and you can't complain about it when it doesn't go our way, right? Like this is what this country's built on. We have a voice. It's a democracy, but if you stand by and don't say anything, don't be surprised if it doesn't go your way. So everyone needs to do this. It's sort of, and that's the apathy sometimes, I think, is just people just, oh, whatever, nothing I can do.
Right. And it's a funny thing, because from a real estate perspective, like it's never been better right now, right? Things are awesome right now if you're a real estate investor. I mean, there's just so much opportunity out there, and the rates on the mortgage side are fantastic, and there's so much opportunity on the financing side. so, this would just kind of like deflate a lot of the energy and the electricity in the industry in the market right now. And it scares me for my clients, specifically because of what you just said, right? Liquidity rushes are going to happen. Got a 2-year run up. That may not work, especially if you're in a construction type fund.
I know.
If you're in and your timelines are not there, it's going to be dangerous. So definitely, we really need everyone to get mobilized and advocate for this. So.
No, I agree. Well, it's good stuff, man. I always enjoy chatting with you.
For sure, man.
Thank you for your time. So once again, why don't you share with people where they can learn more about the firm and you guys,
Yeah.
but specifically kind of what that website is that they can go to get download the letters to send to their.
Yeah. So make sure you check out GeraciLawFirm.com. That's GERACI. You can see right there. Lawfirm.com. And that's where we have a lot of our content there. You can also visit our website to download content about private lending, about real estate, articles and webinars we put out. And also check out my podcast, Lender Lounge with Kevin Kim. Lance was just on it. So that's going to be a look behind the curtain of the private lending industry. And it's all there. And you can find out more about our conferences and all those kind of things at our website, GeraciLawFirm.com. And you'll come find me. And if you have any questions or you want to talk more about this legislation or anything like that, please feel free to email or call. I don't charge for consultations and phone calls. It's not my bag. So
very good. Cool.
Yeah.
All right, Kevin, I appreciate it, man. You have a good day.
All right. Thank you very much, Lance.